Hey, Fear Free Passive Investing listeners, my name is Lucas Miller, and we've got a fantastic interview today with our good friend Brent Kawakami. If you don't know Brent, he's been on the show several times, but he is I'm going to butcher this, I think Vice President of Acquisitions at Think Multifamily. Basically, he buys a whole bunch of deals. And so we're going to talk about my latest acquisition where we partnered together to buy a building in Little Rock, Arkansas, which is it's an interesting market and it's an interesting building to talk about. So definitely stick around for that video in that podcast, but definitely check out fearfreepassive.com if you're interested in learning more about these opportunities. If you're interested in learning more about passive investing, we have a ton of resources that is just jam-packed there. And we're actually working on a course on passive investing. So if you want to check that out, make sure to go to fearfreepassive.com. There's going to be a little bit of a sign up. It's not ready yet, the investing course. So make sure to sign up for the release of that when it's ready. And with that, let's just jump in and start talking with Brent about Tanglewood. All right. Well, I feel like we always start these things with like talking about like how we've been in reality, I know how you've been. We talk like almost every day.
It doesn't have to be formal. You know what I mean? So
yeah. But anyway, let's get caught up with you. What have you been doing? I know you have a bunch of projects going. You had a deal close and sell, and you got one that you're buying this by the end of the year, right?
Yeah. We've been busy, I think, as usual, and inevitably, given the volume our group does, it's especially at the end of the year because everyone's trying to get stuff closed. Which, obviously, the big thing is to close for depreciation, right? Because everyone's looking. Inevitably, a lot of investors, and this never fails, and it actually feels like it happened a lot, given we sold. I think I have to look at the numbers, but think would have sold like something like 10 deals this year, which is good, right? And investors have gains, but now they're like, where do I place the funds? And then everyone waits till last minute type of thing. And so we have a couple of deals that are closing by end of the year here. But it doesn't help because normally this is the time of year when people take their foot off the gas, right? Yeah. And then like the rest of us are scrambling trying to like get stuff done. So
you mean everyone like lenders and title companies and stuff? Yeah.
Oh yeah, for sure. So but so we have one that's closing here on December 30th. So that'll be fun. There's a couple other deals in the group closing this week, and then hey, we closed the deal together here recently too. So
yeah, we closed the deal. We're gonna talk about it. I mean that's kind of the point of this podcast is we kind of want to talk about what was called Tanglewood right now, and maybe a little bit of Normandy too. We'll throw that in there because that's kind of a interesting side story to the whole property. But let's just start by talking about Tanglewood itself. It's 92 units in Little Rock, Arkansas. It's in the Midtown submarket, it played a lot into why we pursued this deal so much. It's a really great location. I think I did like a Google measurement, and it was 450 feet from like a brand new Starbucks. So that was.
You can literally walk there. So which is
in like 2 minutes.
You're golden, right? In real estate, right? It's hey, there's a Starbucks nearby. The only thing better than that is there's a Whole Foods down the street, So.
Whole Foods, or Chick-fil-A, or
Oh yeah, Chick-fil-A.
Whole Foods isn't too far away.
Yeah. But so the backstory on this one, I guess. So you actually saw this property a while ago and had looked at it. Maybe start there with sort of when you first saw it and pursued it and everything.
Yeah, we saw this in early 2020, actually. I think maybe it was even 2019. I can't remember the full story, but I went and actually toured it in 2020, if I remember correctly, before COVID got too crazy. And it was a really good property. It was beautiful, but you could tell it was a little more rough around the edges than it was right now. It was in worse shape financially, just based on the numbers and how things are working out. Property management was rough to begin with. I mean, there's trash everywhere, but the on-site gal was really great. And we'll talk about her down the road, but she, I just don't think she had the resources to really run the property efficiently. Collections weren't great, expenses were high, stuff like that. We offered on it last year. If I remember correctly, I should have gone back and looked what we offered, but it was much lower than the property is worth. We'll talk about that. Right. And we didn't get it. So they decided not to sell. So they pulled it off the market, which is, I think that's pretty typical, where they just kind of want to improve efficiencies and see if they can push their expenses down and their revenue up so they can get a higher valuation. But so we didn't get it last year. And so fast forward to this year, the broker reached back out and said, hey, this is coming back around. Would you be interested in looking at it again? And, we already had a huge step up and a huge advantage over the other people that were seeing it for the first time, is that I had our analysis from last year. I had 2 years worth of financials now to go off of. And so you could kind of paint the picture a little fuller with everything that we had. So when you had our old analysis, it looked much better this time around, which was great. They implemented a RUBS system, so bill back for utilities. So we took a chance. We slightly increased our purchase or our offer price. I can't remember what it was, probably about $10,000 per unit more than we did last time. So kind of like some key takeaways for that is, don't always keep your old property documents.
You're probably like me. You probably have this Dropbox with like layers of history of every property you've ever seen.
Yeah, every property I've ever driven in Little Rock definitely has its own little folder, and usually some notes based on what I saw when I drove the property last time I was in town or stuff like that. So that's huge. But always check with the broker too. Like, hey, did X property sell? What did it sell for? Which we're kind of trying to do that on another property, which is close by that hasn't sold yet. So hopefully we can kind of leverage into that too. But I think we also took a chance too on this property a little bit. We felt like pre-closing, we felt like we were reaching on some things. But now that we're on the other side of it, we weren't reaching at all. In fact, we were probably not reaching far enough.
I think a couple aspects there is, I think, hindsight's 2020, right? But now that, we're probably about a month in, and numbers wise, I think, we'll definitely, hit year one in stabilization faster than we thought. But, another aspect too, that I think is, it's hard to measure sometimes because we're always very data driven and analysis focused, but there's also aspects where it's like, that you pointed out, the area and the submarket, this was a really good location. The whole, hey, yeah, you can walk to Starbucks is great, but that the road that it's on is, one of the busiest thoroughfares there is, in the whole market. You have very nice housing, in terms of, just residential, just nearby, obviously you have, a lot of your, I'll call it your trendier type restaurants and all those things not far by. We went and ate in one area right after due diligence. And so I say all that in the sense of, those are aspects of properties that, you always can't, there's intangibles, right? And I think in this instance, that was one intangible here, was that the submarket was a really great submarket, for sure. And then, the valuation, it doesn't mean anything today, but, the appraisal came in, I think $1 million more than we bought it for, or like 10K or more, which is great, right?
Yeah. When your property can appraise for $1 million more than you're paying for it, like you're doing something right. And obviously that doesn't mean a whole lot right now. Like that's not $1 million in our pocket or anything, but it just shows that there was true value in this. And we had a good going in basis for success. And I think that's really strong because it shows that we can kind of just do status quo almost, and it's going to go up in valuation, continue, assuming cap rates continue to compress. But obviously, we're not going to take our foot off the gas, like you said. We're going to keep going, but the contract process was really smooth on this, I thought.
Yeah.
A few little hiccups here and there, but nothing crazy. We've both done much more.
Yeah. I think overall the whole transaction, I think, was fairly smooth from the contract, the lender, due diligence. There wasn't a lot of stuff that seemed like, was too crazy, which, knock on wood, you never know, right? But every transaction is different, and so you just kind of roll with it.
I think the biggest hiccups were just like things going slow. I think a couple people got COVID during it, and that slowed things down. We had trouble getting our third party assessments done, like environmental appraisal, stuff like that. Everybody's backed up right now too, which is crazy. So we did have early access to, which allowed us to go in and do our due diligence early, which that also went really smooth, surprisingly. Nothing major came up. There were some slight foundation repairs, but the seller actually just fixed it before we even knew about it. And that just goes to show that this was a really good seller too. This was kind of like an investment for them and his partner. It wasn't a big fund or owner that owned it. I think this was their only property.
The quote mom and pop, quote unquote, type of thing, right? And that also it helps too, because that's opportunity, right? I mean, as an example, they were running nearly full at all times, right? Which is a general statement, is actually counterintuitive, but that probably means you're not charging enough, right? And then, there were a handful of units on the property where, just weren't being maximized, right? Like you mentioned, I think, was it the partner's mom was living there at a subsidized rate. You had staff living there at subsidized rates. There was a mother, like a partner and a mother-in-law. Like you remember the details better than I do, but
there was a lot of non-revenue rent. Not just that there was no rent coming in, but they were also paying for their utilities, which that's another expense. On a 250 unit property, you can kind of absorb some of that stuff, but not on a 92 unit property. That's, you need every dollar you can get on those times. But and another big thing was, this is a chiller system too, which, if you don't know what that is, it's a universal air conditioning unit essentially for the entire complex. There's a hot water heat and so universal boilers and universal air conditioners. The chiller wasn't super in rough shape. It was a few years old. And I say a few, meaning like, I think it was close to 20 years, but those run for, in some cases 25, 30 years. So it wasn't, I remember we saw it last year or the year before, and the broker was like, oh, it's got a bunch more life left in it. And it didn't. So, but the seller actually just opted to replace it. Pre-closing, pre-market, he just decided, hey, I'm going to replace that. That's a $90,000 piece of equipment with an 11-year warranty, done by a major brand. That's not a cheap thing. That's a huge risk mitigation that we took into effect, and that's probably played a lot into that valuation being $1 million over what we paid. So I'm still shocked that kind of worked out the way it did.
Yeah, no, it definitely makes you feel better, because every property's got things you like and things you don't like, right? In reality. Example here, it's like, well, not a huge fan of the chiller, right? That's not to say it's a bad thing. We've bought other properties with chillers on it. It's just kind of something you take into consideration. Your downside obvious is, hey, if you're in the middle of summer and it goes down, the whole complex doesn't have AC. Then staff's scrambling around trying to mitigate and figure things out. But in this instance, the fact that, like you said, seller basically put in a brand new chiller, makes you feel better about that aspect of the property. I guess maybe it'd be good to kind of talk through, what other sort of improvements we have planned for the property.
Yeah, I think the stand or the one of the downsides to this area is, or I guess this plot is there's not a ton of amenity space. So there's not a lot of grass, which is good because we don't have a ton of landscaping, but there's a lot of flowers and trees and stuff that still need to be taken care of. So we can't eliminate landscaping totally, but there's not a lot of space to put, the standard gazebo or playground. There's not a lot of kids at this property anyway, or if any. I don't remember ever seeing any kids. Not by design, but just because that's the way it is right now. So we don't have a ton of amenity space. And so what we do have is a really cool pool. And we're going to make that a nice space. So we're going to do like some cool accent wall paintings. We're going to do some furniture. And we're going to kind of make that a really nice gathering spot for the whole community. And then like a dog relief area, pet relief area.
Where they do their business, right?
Where they do their business, because they're already going over to the one green spot we have. We might as well put some bags out and make it kind of like a nice little spot for them to be anyway.
You make it official, right?
You make it official, yeah.
This is the official going spot.
Yeah. But the other stuff is really just capital expenditure stuff that's been neglected for quite a while. A lot of the stairwells in the area are metal and they're kind of rusted out. And actually, the funny story is when it was being appraised, the appraiser actually fell through the stairs as he was taking care of our property. So that was a little interesting. I'm surprised we got the valuation we did, but that wasn't a huge deal. So we got to take care of all those steps and make sure that they're welded and safe and got new wood on them. There's a lot of dated stuff that just needs to be, sanded, power washed, painted, taken care of. Silly things like that add up. Tree trimming, gutter cleaning, stuff like that. That really isn't a big deal, but it's just going to cost money. And like we said, this is kind of one of those that it's not a huge, deep value add right now, which is a good thing, I think, where we're at in the market. But I think it's also one where it's easy to kind of forget about and let it go and slip on operations too, which, maybe you can talk about that, where we're headed with that in a few minutes. But
yeah,
I mean, just to wrap that part up, it was a really attractive property to a lot of investors. I think everybody liked the location, but it's a good looking property. It's a little older, but I like it.
Yeah. It's definitely, it's got a kind of, I'll call it quaint feel, when we drive up on it type of thing. And like I said, I think the location aspect of it makes it great. And then operationally, so, one great part is, like you mentioned before, I think they had a good manager there. But to your point, I don't know that, maybe she had all the resources or were empowered to necessarily take things, in a different, to the next level. I don't think that was ever the intention anyway, like we said.
Yeah.
But, we'll bring our manager in. We've had, I think, this particular manager so we had them at 5 other properties in the state at this point. Really great. I mean, just top notch, has done an amazing job. I think every one of those properties, we started distributions early on those, and knows the market, was familiar with this property in previous lives. And I think what was kind of a good sign is it was a thing where when she saw the property this time, it was in better shape than she remembered it, which was good.
I remember when I brought it to her, she was a little disappointed with it. She said, "Oh, I don't like that property." But then the first time she went there, because I was like, I'm buying it anyway. Like, this is a good property. I like it. So the first time she went there, she's like, "Oh, this is way different than I remember." And she's like, "This is great."
So it's that goes to show you, like, it can change, right? And some of it's just how you operate and money being put into stuff. But that'll help operations, which is good. I think we have a great team there. The other aspect too, which is neat, is, and as we're walking through this, it kind of coincidentally happened where we had think we're buying a property down the street at the same time,
Right.
which was kind
Like
of
literally down the street.
yeah, which is kind of coincidental, and it all kind of the stars aligned in a sense here because we were able to do due diligence at the same time, which works out well. And then also, we're operating the properties basically as one property,
Yeah.
which is good because it gives some scale to both properties, right? Because both are this other one's an 80 unit, this one's 92, so a little bit on the smaller side than we normally look at, but together, right, you have some good unit count size, right? And we can share staff and operate kind of together, which creates some synergies, right?
Yeah.
Between the two properties. And so from that aspect, operationally, it works out really well. Given they are, literally right down the street. So that was kind of a nice thing that worked out.
Yeah, I think running the properties together could be good and bad. I think in this scenario, I think it works really well. We mainly because we had to get rid of that manager who she was great for Tanglewood. But unfortunately she was very expensive for that property. She just wasn't the right fit for that property. For another property that was bigger, that she would probably be a great fit. But what we were able to do when she left was hire some really good folks to oversee both properties. We were allowed to get really good maintenance folks, which is always a struggle. And our on-site leasing team is really great so far. And I think that's really one of the biggest keys right now is labor is really hard it's a struggle for everyone, not just the apartment industry. Like every industry, labor is hard. Yeah. So if you can nail that, I think you're going to be okay in the long run anyway. So some economies of scale is good for that. But I think it's also going to help when we start the renovation process. What we already are. But we're already trying to shuffle crews back and forth, and it's working really well so far. Time will tell, but I think in this scenario, it works really well.
Yeah. I think the other aspect too, and this is a little down the road, as a general statement, but when you get to a capital event perspective as well, and we don't know how this is going to go, but it in a lot of instances it may be beneficial to package them, right?
Yeah.
In general, right? Especially say you go on an exit or a sale. Hey, 92 units or 80 units individually may not be as attractive as both of them, right? 100 was that 170, 172. That's a much better number for most folks in our space, type of thing. Again, early to tell, but that's another aspect down the road that can be beneficial doing that. And so, it's a nice like I said, it was kind of coincidence that happened.
Yeah.
Which worked
we
out.
actually almost closed on the same day, which was kind of interesting, but and that's kind of an important thing too, to note is these were totally separate transactions. Like one was different lender, different, ownership team. And, but we just kind of blended them together at not really the last minute. Like we kind of planned it, but it worked out really well. And so on this particular property, Tanglewood, we're doing a bridge loan. So it's a 3-year term, 3 years of interest only, 30-year amortization. So when we do get to that capital event, like you were talking about, either a sale or a refinance, we are going to need structured debt that will be more attractive than what we have right now. And so hopefully maybe at that point we can assess, bringing them into the same loan or something like that.
Yeah. But time will tell, right? Who knows, right?
Time will tell, yeah.
But options are not a bad thing, right?
No, yeah. You always want to have more options than less. But let's talk about the capital raise for this one, because this was kind of an interesting story. Literally the quickest I've ever.
So not to, so people like to create false senses of urgency a lot in our space, which, it just is what it is. But this one was the fastest raise I think have ever had. I think we had overcommitted like within 12 hours, I think is about
Yeah.
what it was, which
Yeah.
again is insane, right? Just crazy. And,
Yeah.
good problem to have, but definitely not the norm.
Yeah. No, it was kind of a crazy, I mean, 15 hours really, because it was like, well, we weren't really sure how things were going to go. There were a couple other deals that we knew of that were being raised for. And I think a couple hours into it, I was texting Brent to like, hey, turn off the portal. We have enough people. Like, we need to slow
Yeah.
down a little bit. But yeah, that was really fun. That was,
Yeah. I
I
think
wish they were all like that.
yeah, I think just some aspects on why and some things there. So um I think one, so size of the deal, right? So this wasn't like a massive project, right? This wasn't a
Yeah.
200, 300 unit type of thing where the amount of equity required is like 5, 6 million. It was less than two, right? So
Yep.
it's definitely that's one aspect that contributes to the speed. I think another aspect to the speed has to do with market, right, and the
Mm.
deal. So just it is what it is, where it's like certain markets and certain deals are just more attractive than others for whatever
Yeah.
reason. And I think we talked through several pieces of this, but it was a good looking deal, right? Good looking
Yeah.
deal in a solid market, that type of thing. So I think that was definitely a factor. I think too the other aspect of is how we marketed it, or how we went
Yeah.
out to investors as well. We individually went out to our own bases. At least for us, I think we obviously have a strong base and a good investor pool that we can go to, and the fact that, hey, we went alone to it, and we have a hand in it, so to speak, directly, has a huge factor in it as well. And so
Yeah.
I think you put all those factors together, I think that's why it was like that. Like you said, I wish everyone was like that.
Yeah.
But yeah, it worked out well.
Yeah. I think one of the bigger things that I learned and I took away from that is, and I'm really guilty of this on past deals, is overcomplicating things, like making it way more complicated than it needs to be. And you know, I on this one I liked it because it was very simple. We just went out and we pitched it to investors. There wasn't a ton of work that went into the presentation. There wasn't a ton of work that went into the script and what we were going to say. I think a lot of that is because I knew this was a good deal and I was really excited about it. And I guess we were just kind of nervous, like, were other people going to see that? And clearly they
Yeah.
did. So
Yeah. Every deal you get nervous though, right?
yeah,
Every deal, every time you're raising capital, it makes you nervous every time.
as it should be,
So
right? You're taking a lot of
yeah.
money in, and it
Yeah.
probably should be.
Yeah.
But yeah, closing thoughts. One, I really like this market right now. That was a huge takeaway, especially with that raise. Like, I really like Arkansas in general because, the landlord friendliness played a huge factor into some of those other properties starting
Oh yeah.
distributions early on your side.
Yeah.
Um, Smaller properties like this, I think I really enjoy because they're smaller, raises like you were talking about. This one was less than 2 million. I wish it was bigger, but I still really like this size. Being open to trying new things, like just completely separating, doing our own presentations, running the properties together. There's a lot of new things on this one, which is cool. And keeping the general partnership, the ownership side, small. I really like that. There's not a million investors in the deal. There's not a million general partners in the deal. It's just very clean, and I really enjoy that. So what about
Yeah.
you? What are your closing
Yeah.
thoughts?
No, those are all good points. I agree with all those. I think with and we say small, right? But it's like,
Yeah.
hey, 92 units, 80 units, like there's a decent size too, but it's just not traditional like some
Yeah.
other
Smaller
projects.
than what we're
Yeah.
used to.
I do think, back to like a market perspective, that's one thing that, we always say like, hey, zig when other people zag, right? And I
Yeah.
think when you look at that sort of range, because we bought these properties, we bought a 102 unit here in Dallas earlier this year. So they're kind of like in that we'll call it lower end, quote unquote, of where we operate. But as a general statement, and I've talked to brokers about this before, but it's like you have that range where, you know, there's not as many eyeballs necessarily, right? Like if this property, if Tanglewood was 200 units, 250, right? There'd be 30 eyeballs like trying to offer on this thing, right? Yeah. Like, you know, probably would have got way more competitive in general, right? So you have that aspect where you can float a little bit under the radar in some of that side of things. And then the other piece of it too is that for us, you know, we're a step above a mom and pop, right? But we're not like some institutional client. But as a general statement, we're a little bit of a bigger player in that range as a general statement, right? Maybe, you know, you have someone who's buying that 92 unit, maybe this is their first larger property, right? So to speak, or you still have some mom and pop type of folks. You're not. And so as for us, it works out very well because we're not necessarily always competing with 30 other more institutional, you know, type of buyers, right? So I say all that in the sense of, you know, I agree. I think all those are good aspects, and you know, you like sort of, I call it bite size type of deal, type of thing, and you know, if we can do more of it, you know, great. So
I think just having access to a little bit more resources than a mom and pop buyer, but it's similar to the people we bought it from. Like, they're probably very high net worth individuals, but they're not focused on this. They don't know the resources. They don't have the team in place to put together a really quick transaction that, you know, probably got us the deal. Because it's not their full-time job and it is ours. So
So, but yeah, no, it's good. I'm looking forward to the transaction and seeing how things progress. And hopefully we have another one of these in, you know, a couple years, and we're like, hey, you know, we're look where we're at now, right? So
well, cool. You know, if you all want to, you know, hear about more of Brent's projects and see what he's doing, contact information will be in the notes. He's pretty easy to find, Brent at thinkmultifamily.com. If you missed this deal, and there were actually quite a few of you on my list that did miss this deal, you want to invest in future deals like this, head to fearfreepassive.com or thinkmultifamily.com, or just send us an email and we will get with you there. But thanks, everyone.
Sounds good. Good chatting with you.
You too.